Good morning, good afternoon, and good evening. My name is Trang, and it's my pleasure to be your host for today's Refinitiv Perspectives live stream. As usual, before we begin, I wanted to encourage you to complete today's polling question. As gold and silver prices continue to surge, we'd love to find out what precious metals, if any, you're currently investing in. Please scan the QR code on screen now or click on the link provided in the chat box to get to the question. Gold has become one of the hottest investment themes in 2020 as investors look for safe havens amidst continued concerns over a pandemic-fueled economic recession. Benchmark gold futures in New York have hit a 9-year high in early July at $1,820 an ounce compared to $1,400 in just last year. Silver prices have also rocketed to their highest in 7 years in the second half of the month. Demand, including by those who don't typically invest in precious metals, have spiked as governments around the world have flooded the global economy with cash. A weaker currency, aggressive stimulus measures by central banks, and worries over a potential extreme inflation or deflation or both have provided an appealing investment landscape for precious metals. The rally in gold, however, has also weakened the jewelry industry in Asia, especially in its top two markets, China and India. Demand for gold in China has plunged by 55% in the first quarter of 2020, according to Refinitiv Metals research, as consumers, unsurprisingly, focused on buying essentials instead of jewelry amidst the coronavirus outbreak. Gold imports in India have reportedly plummeted by a staggering 86% year-on-year in June, amidst record high prices and a ban on international travel and weddings, which are a massive source of demand for jewelry in the country. So confidence in gold as an investment tool is really on the rise, while at the same time, the physical market has taken a massive hit. The question stands, what's really the long-term market outlook for precious metals in Asia and beyond? And these are some of the topics we'll be discussing today with Cameron Alexander, Manager for Precious Metals Research from Refinitiv. Welcome, Cam.
Hi, good afternoon. Nice to be with you. And hello to everyone on the call.
Thanks, Cam. So I guess gold prices have really hit a record high in recent weeks. And if I'm not mistaken, just yesterday, they've exceeded the $2,000 an ounce mark. What do you think are the key drivers for this price surge?
Yeah, look, we saw the price push through that $2,000 barrier last night, and that was quite something. I think, word uncertainty. I think the market is being very much prepped by the lack of certainty in the financial markets, and that's driving the prices to where we are today. We saw gold prices push 33% higher since the start of the year to where we are today. We've seen gold prices jump 12% in July alone. And what's driving the price is that lack of certainty. We've seen the US dollar, which was very strong during March when we saw that initial sell-off in the equity market. The US dollar was at a 3.5-year high at that point. Since then, we've seen the US dollar lose a lot of ground, dropping to a 2-year low. And dropping 8% since we saw that March high. So that's one signal that's driving the market. Obviously, at the moment, we've got COVID and the impact that might have on the economy going forward. And so I think investors are now very cautious about where the market is going to go in the coming months. And that's why we've seen money move away from probably traditional asset classes, and we've seen bond yields at very low levels, interest rates continuing to fall, and in real terms are in negative territory. And so, investors are looking towards a safe haven, and and gold is obviously providing that at the moment. And the outlook is still very positive.
Thanks, Cam. Refinitiv has recently released its metals research update for Q2. Can you share perhaps some of the key findings, especially when it comes to supply and demand trends in APAC in the first half of 2020, and what this means for the rest of the year?
Yeah, sure. I mean, in terms of a global overview first, I think supply was down by 14% in the second quarter. So even on the supply side, we saw quite an impact from COVID and the shutdowns. Mine production dropped 12% for the period, and we did see quite a lot of mine closures or temporary shutdowns during that period. Scrap, on the other hand, was surprisingly weaker, which is a bit of a surprise given that gold prices were surging during the second quarter. But that was mainly a reflection of sort of weaker collection in Asia. A lot of these places were closed, so refineries and also places that collect gold were shut down because the retail outlets were shut. But in North America and places like Europe, we did see quite a rise in recycling levels there. but overall, recycling was actually down, which is quite a surprise for the period. You mentioned jewelry in your outset, but physical demand overall was down by 36% in the second quarter, so that's quite a fall. And there was really not many areas that were left unaffected. But most segments were down sharply. Jewelry was down by 50% or 53% in the second quarter alone. That's the lowest quarterly level seen for the past 2 decades. So quite the impact there. Industrial demand was down by 16% in the second quarter. That's sort of encompassing electronics, medical and other dental and other industrial areas. So that was down quite sharply, and that's the biggest fall we've seen, in several quarters. And look, the official sector, so central bank activity, that's really been a great supporter of demand over the last couple of years, and we've seen some very strong demand from that sector. They were down by 40% in the second quarter, which was quite a surprise. And that's really on the back of the absence of buying from China and from Russia. And Russia came out, which really been the largest buyer of gold in this sector over the last few years. And they came out in end of March, suggesting that they would stop buying gold or selling gold into the market. The government's going to stop buying gold from April, and they have not done that since then. So every month since, we've seen no Russian activity, and that's driven down the overall net purchasing in this sector. Retail investment, which is sort of the sum of coins and bars, retreated by 2% in the second quarter, and by bar investment was just down by about 1%. Now, there's quite a contrast, in the global sense. If you see, in European and North American markets, so more the industrialized countries, saw very strong demand for bars and coins. Whereas in Asia, we saw quite the opposite, and we saw quite a lot of this hoarding of bars, people taking profits and selling back their old gold assets to book a profit. Also the fact that a lot of these places were closed during this period also meant that retailers, weren't open, and consumers, investors couldn't get to these outlets to actually purchase their gold. Places like in India, we saw a bit of a pickup in ETF demand because, again, consumers were basically locked in their houses, but also an increase in sovereign bond demand. So people were also buying, through that method rather than going to the shops and buying coins and bars. But I guess the big story from the numbers is the ETF demand. And we saw in the first quarter this year that ETF inflows were around 300 ton mark, and in the April to June period that kicked up again to 436 tons, I think, for that period. So overall, holdings in ETF pushed through that sort of 3,600 ton level, and if we continue on this sort of path, we're certainly in line for a record level for the full year. So that's really been the area. I mean, in terms of obviously, investment demand is really driving the gold price at the moment. So it's been, trading on gold futures, as you mentioned at the outset, and ETF demand. We're seeing a lot more institutional investment through ETF. Also, small scale investors are also coming into the ETF space at the same time. If you look at just Asia, in isolation, and jewelry fabrication across Asia as a block was down 56% in that second quarter. And that was after a 42% fall in the first quarter. So, quite a hefty fall there. So almost 50% down on a first half basis. Now, this grouping as a whole, includes the two big giants, obviously China and India, as you mentioned. And they just, Asia as a group counts for 80% of the global fabrication market. So any real shifts in either of these two markets have a massive bearing on the global demand picture. Chinese fabrication, was probably China was really the first country to go into lockdown. So the impact in the first quarter was extreme for them. And so the writing really was on the wall for other countries in the region, what might transpire in the second quarter. First quarter demand in China was down by some 54%. And even though we saw quite a strong recovery, on a quarter by quarter basis in China, overall demand was still down by nearly 20% on a year-on-year basis. So that reflects just how weak the market has been, and the lack of consumer sentiment, and drop in retail sales still exists in China, as they are quite concerned about where the economy is going. I guess discretionary items are one thing that gets dropped very quickly when things are tight on the home front. Indian gross demand dropped by a staggering 65 or 64% in that in the second quarter. 40% down in the first quarter, But then we saw a 94, I think it was 94% drop in fabrication in the second quarter in India. So quite a staggering figure there. If you look at India, I mean, they were impacted obviously in the first quarter by firstly higher gold prices. I mean, gold was trading at record levels in Indian rupee terms, so that was holding down consumer demand at the time before COVID even kicked off. And then by the end of March, I think by mid-March, lockdown had been implemented in India, and that pretty much lasted right through the quarter, with most retail activity shut down. All fabricators were forced to close, and obviously the public have been forced to stay in their homes for several months now, and only obviously some parts of the country have had their restrictions lifted, but major centres like Mumbai and parts of Delhi are still in some form of lockdown. So yeah, so certainly from the Asian point of view, a big impact.
Well, lots of things and quite a negative outlook in some ways. And I think I will come back to the jewelry industry in a short while. But first, I think you mentioned about the potential impact on mining operations. So I was wondering, what do you see as I guess, the biggest impact on mining ops, and what does this mean for production output for this year?
Yeah, right. Well, yes. So I mean, the miners were still also sort of prone to the impact of COVID, and we saw a 10% fall in production in the first half. The second quarter was where we saw most of the impact, and that was down by some 12%. I guess if you look at losses were seen in several areas, in terms of the globe, but most of it was in sort of South Africa, Latin America, and Africa. We saw some falls in Argentina as well, and Peru and Indonesia. Were also weaker on a year-on-year basis, and particularly in that second quarter, as they were forced to shut down in a bid to stop the spread of the virus. Surprisingly, we saw Australia and also Russian production actually increase in the first half, as these markets were sort of slightly lucky to get through without having too much impact from the COVID lockdown. No, I think we obviously monitor mine sites across the world. In terms of the precious space, we saw nearly 130 mines that were at some point shut down or in a temporary lockdown conditions. A lot of those have come back on stream now, but we expect that the impact for the full year won't be that bad, in fact, because we think the production will be made up mainly over the next 6 months. So the losses will probably only be around 3 to 4% for the full year. Now that really just depends on, of course, what happens in the next 6 months in terms of the COVID spread. There may well be more second waves in some of these markets, and so there may well be further shutdowns and closures, which will have obviously a detrimental impact on production. But at this stage, we're looking for about a 3 or 4% decline in mine production.
Thanks. So you mentioned a massive decline in jewelry fabrication and also retail demand in much of Asia. Do you think the industry can recover in the foreseeable future, or how do you envisage this happen?
Yeah, look, I mean, the market is incredibly resilient. So will they recover? I think they will. But it's going to there's a lot of pain to come. I think we're going to definitely see bankruptcies and a lot of people exit the industry. But these people in looking at the Asian market particularly, I mean, have been through a lot of these kind of financial crises over the years, from the Asian crisis to the global financial crisis, and now this one here as well. I think the market's going to look quite different by the time we exit. I think we are going to see people leave the industry and retailers forced out. We've seen certainly in the markets that I cover, a lot of retailers already forced out or are struggling at current levels because there is no foot traffic. The consumers haven't been in the market buying, and so they're paying rent on these places. The shopping malls are empty, and shops on high street or even small scale shops in some of these Southeast Asian countries. There's just no people there, so these people are struggling. There's no doubt. If you look at the fabrication side, obviously without any retail demand, the fabricators have nowhere to sell their product, and so they've been forced to close as well. And a lot of these, across Asia particularly, are big employers across the industry. And as I mentioned at the top, Asia really dominates this space in terms of global fabrication for jewelry, and are a very large employer. So without fabricators, a lot of people are being sent home. A lot of workers in sort of these urban centres have been sent back to their villages and smaller towns outside the cities. and that's having a big impact. No, I wouldn't be surprised if a lot of these big fabricators in Asia are often family-run businesses as well, and a lot of them, funny enough, own their own gold. So in Western markets, the big fabricators would lease their metal for fabrication. But in Asia, a lot of the businesses are smaller, and they're family operated, and they often own their own gold, which they've built up over the many years of operation. With gold trading at $2,000 plus at the moment, and in local terms, in local currencies, at obviously record highs that we haven't seen before, there may be an opportunity for people to take some profits and to sell down some of their assets. So we may see fabricators reduce their fabrication on a monthly basis, or some even get out of the market. Younger generations today are running a business that maybe their parents or their grandparents started, and the jewelry industry is very low margin, it's very hard work, it's very labor intensive, and so we may see some younger generations decide that it may be better to take some profits off the table and to redirect those funds to other asset classes. So the market could change, but I think in terms of resilience, I'm sure they'll bounce back.
Interesting, thanks. It might, I guess, lead to an economic shift after all. Moving on from, I guess, the impact on physical markets, I wanted to touch on the impact on financial markets, and you've touched on ETFs. But what do you consider as some of the key trends in terms of investing in precious metals and gold in particular in response to COVID-19?
Yeah, look, you're right. I mean, the fundamentals that we've just spoken about aren't really driving the market. I mean, that doesn't really have a great impact on price. It's really going to be the macro side, and where the market perceives, the financial markets heading in the next, 6 months to 12 months, which is going to drive the price. So with that in mind, it's really going to be investors that are going to push the price higher or lower. At the moment, we're seeing, very strong, demand on the futures market. We're seeing continually building up to record levels. ETFs, as we mentioned, are at record levels. We're seeing a lot of institutional investment at the moment through ETF, but also in markets where we haven't seen ETF demand, surging. In places like India, we're seeing good demand. In China, ETF, we're seeing good demand. So I think from the investment side, we're going to continue to see, particularly as we start seeing, the economic outlook still, be quite questionable. A lot of discussion about how quickly can these economies bounce back from the current situation. There's a lot of rhetoric from the US about, a V-shaped recovery. The President Trump at the moment is talking about, COVID just being a bump in the road and that the economy will bounce back quite quickly. I'm not sure that the financial markets have the same optimism about that, and that's one reason why we're seeing gold prices perhaps move higher. I think at some point, as we continue down and we continue to see sort of poor economic data coming out of the US, if that continues, then I think we're going to see a further weaker US dollar, and potentially gold prices could actually move higher under that scenario. In Asia, we've talked about this hoarding, and we're seeing a lot of people profit taking from these record prices. I think that's going to continue in the short term. I think if we continue to see gold hold at these kind of levels, I think we're going to still see a lot of selling back from markets like Thailand and Indonesia and perhaps Singapore and across India as well, because that's they can take that money and use it, or use it to keep their family going in times of uncertainty and perhaps unemployment, which are on the rise through a lot of these markets. So from that point of view, I think that's the key. I mean, if prices were to stabilise in Asia, and there's an expectation that prices could perhaps move higher, then I think even investors in Asia might come back to the party and to start to buy to rebuild up their stocks. But if there's uncertainty and we're seeing a fair bit of volatility in the price, then I think there may be I think we're going to continue to see this kind of hoarding in some of these markets. And I look at the supply, the trade flows coming in and out of the countries quite regularly, and some of these markets across Southeast Asia continue to be net exporters of gold, where typically they would be importers of gold for the fabrication and investment demand. But in the last few months, they've been exporters. So that gold's been sold out and coming back to refinery markets like Singapore, Hong Kong, or here in Australia.
So I guess the $1 million question would be for many on the call is what would be your top tips for those interested in investing in gold and especially, I guess, investors who are quite new to precious metals?
Well, there's a lot of ways to buy and trade in gold. I guess that historically the easiest way has been just buying the gold bars and or coins. I think here in Asia, and we've got a very, historically set up for that trade. It's, there's a lot of retailers who buy and sell and trade, gold bars and coins. And in contrast to Europe and say in North America, the premiums on our products sold in this region are relatively low. So you can buy and trade back and forth without losing too much money. The margins are very slim. Obviously that's one way. And it's also very liquid. So you can buy a gold bar in Singapore and take it to Hong Kong or take it to Indonesia and sell it, and you can get your money back. It will hopefully make a profit. But there are other ways you can invest in gold, and we're seeing that increasingly through sort of ETF demand. So younger generations are moving to these exchange traded products, ETF. We're also seeing things like online platforms, again across Asia and places like Thailand and Indonesia. We're seeing increasingly more online platforms where traders can day trade, if you like, and take short positions without having to hold and hoard. I guess traditionally people would buy gold and keep it under the pillow or under the mattress, and then take it out when prices have moved sufficiently high enough to take a profit. When you're day trading on a platform, you can sort of buy in the morning and sell in the afternoon, and that risk exposure is probably a lot less. So from that point of view, it's something that we're seeing a lot of. I guess the other one is in mining equities. So investing in companies that are actually digging the gold out of the ground. When the gold prices are surging like that at the moment, this sector really is quite hot. So it's the mine producers themselves or anyone that's involved in exploration. So a company that's looking for gold or might have drilling results coming out, invest in these kind of stocks can give you very strong returns in a bull market. That said, you have to be a little bit careful because we've seen in the last few years that mining equities have underperformed gold performance, the gold bullion performance. So when in a bull market you might see it outperform, but there are times when they don't hit that benchmark. So that would be the main areas I would say in terms of investing in the gold space.
Thank you. And I guess the hiding behind a pillow reminds me of what my grandparents used to do when they invested in gold back in the day. But like you said, I think there's this shift, especially with the younger generation, towards online platforms. Yeah. And a concept that I came across during my research for this live stream is digital gold, which I think is not necessarily something that many are familiar with. Would you be able to perhaps give us a lowdown on what investing in digital gold entails and what are the potential benefits and drawbacks?
Yeah, look, it's a relatively new space for gold. Within the gold investment space, it's been around for a few years now, but it's sort of really emerging. There's a lot of companies coming on board with this new technology and as a product offering. I mean, it's essentially a blockchain-based digital token technology, similar to Bitcoin. Though sort of in contrast to Bitcoin, it's actually physically backed by something. So gold is actually held when you're trading within this product. I think some of the benefits of using this kind of product is that it's you can buy in micro volumes, so you can buy in very small amounts. So you're not buying a half a gram or a gram or something like that. You're actually buying in hundredths of a gram or thousandths of a gram if you want to. You can buy and sell continuously, so you don't have to be you can basically, it's like online platform. You're on it continuously, buying and selling if that's what you choose to do. There's also increased security and traceability, and that just comes back to the blockchain technology. I guess one of the drawbacks, and this is not really a drawback in the sense that younger generations are certainly adapted to this kind of technology, but across Asia historically, as you mentioned, your folks or grandparents, people like to hold their physical gold, and that's changing rapidly over time. But in the past, people would like to buy their gold and know they've actually got an asset in their hands. Be it in the safe or under the pillow. So that's one of the drawbacks that older generations perhaps might struggle with this kind of technology. But as younger generations adapt to online trading with their mobile phones, they can use the same technology with their phones for this kind of blockchain technology. So and I think it's got a big future, but at this stage, the volumes involved still remain very low, comparatively speaking to sort of other means of investing.
Thanks, and perhaps this is an option for those who are quite new to investing in precious metals. So I guess we covered gold quite a bit, but I was wondering whether we could touch also on silver because prices have also skyrocketed in recent weeks. What are your thoughts on silver?
Well, yeah, silver's really had a bit of a roller coaster ride, hasn't it? It's up 45% this year, which is quite extraordinary. And we talked about gold's rally through July, and silver's up by 25% in July alone. You think about that 25% jump was the second highest ever on a monthly increase, so quite an increase. You think about silver, now it's sort of close to $26. I think it's just below $26 today an ounce. Back in March, when we saw a big sell-off across metals, that price was $12. So quite extraordinary to think that $12, it was $12 in March, and today we're sitting at nearly $26. So that's pretty crazy. And if you look at the silver to gold ratio, even today's prices, silver is undervalued compared to gold if you're using that as a metric. So we saw that big sell-off in March. We saw the silver to gold ratio surge to 126 to 1, I think it was at the time. It's sort of come back right down to sort of 78 now. But even still, if you compare that to the long-term average, which is sort of in the low 60s, silver is still undervalued compared to gold, or gold is expensive compared to silver. So there's still quite a big potential upside there for silver if you use that as a metric. I think silver really hasn't been in favour with investors for quite a while. Certainly over the last couple of years, silver's been viewed very much more as an industrial metal than as a precious metal. And silver can wear sort of two hats from time to time, and sometimes it's got a tight correlation with gold, and we see gold and silver move quite closely together. And other times it moves much more closely related to zinc and copper and other base metals. And that's really been the case what we've seen over the last 12 months. And during 2019, as base metals were sold off, as the trade wars between the US and China accelerated, silver was also pulled down from that point of view. So investors really sort of stayed away from the metal for some time. And that we saw, obviously, silver sold off heavily in March, as other base metals did as well, when I think the financial market started to realise that COVID was more than just a isolated incident, and it was actually a global pandemic. And we saw that the sort of economic outlook start to weaken. We saw a sell-off in base metals, and silver was dragged lower then. So it's really been the last few months that silver and gold have started to have a tighter correlation. And silver in the last 6 weeks has really taken off. Investors have come back with a vengeance, and we're seeing prices where they are today. I think I would add a little bit of concern there that we're seeing silver prices move very quickly, and we could see a bit of a pullback in price in the short term while prices consolidate. But if you take the silver to gold ratio as a potential metric, then silver could have some further upside.
Thank you. And I guess when we ran the poll I mentioned at the beginning around investment trends in precious metals, unsurprisingly, gold was at the top, but I think quite a few people chose palladium, which I think is a precious metal that's mostly used in pollution control devices for cars and trucks, and is also a precious metal that was in the spotlight last year, with value having doubled because of dwindling supply. What are your thoughts on trends for palladium for this year?
Look, we saw massive sell-off, early in the year in March, and again, that was all based around, the economic outlook. Vehicle sales dropped significantly over the last, the outlook has dropped massively. So, look, I think this year for palladium, I think prices will probably rebound slightly. I think the biggest concern is the supply issue. Demand remains weak, and it's probably going to be weak for some time. And places like China, we've seen a bit of an uptick in demand, so that's slightly positive for the metal. I think palladium prices are going to be certainly weaker than when they were last year, but they're still holding at relatively high levels. So going forward, I think palladium prices are going to move back to where they were potentially, last year. At some point, demand is going to rebound from the auto sector. On that supply side, at the moment, it's still relatively. We're still in a deficit for the metal, so there's still less produced each year for demand. This year is going to be the other way around. We are going to see probably a slight. We're going to move away out from a deficit last year. We're going to see a slight surplus in 2020, but back into 2021, we'll be back into a deficit situation. So prices of palladium are more likely to move higher next year than this year, I would think.
So perhaps that's one to look out for. So we're nearing the end of the live stream, but I just wanted to ask you one final question. What's really your long-term price and market outlook for precious metals?
Well, we expect that monetary and fiscal policies around the world will continue to be supportive for gold. I think at least in the short to medium term. Bond yields and short-term interest rates should stay very low in nominal terms, and in real terms, obviously moving into that negative territory. Geopolitical risks, they haven't gone away. I mean, even though we're talking about COVID and that's really been the main driver for the economy, we've got situations with the trade wars in the US and China. We've got the US election coming up, and we might see a bit more chest beating in the coming months as Trump and others want to highlight the situation in China. Brexit negotiations are continuing. We've got Middle East conflicts still simmering away in some of those markets. So from our point of view, we think this is very supportive for gold, at least in the short to medium term. Can gold continue to go higher? Yes, we think it can. We see gold prices pushing through $2,100 potentially this year. $2,200 an ounce is also potentially possible this year. It really depends on what happens in the next month or two. If the US economy can rebound, and that's something we're not quite sure about at this point, then gold prices could come back off. We could see gold prices back below $2,000 and back below $1,900 in fact. But if the economic data coming out of the States in the coming weeks and months continues to point to a recession and higher unemployment, then I think the recovery is going to be much slower. And I think the economy and the federal governments are going to have to do a lot more stimulus, which is going to drive the US dollar down. And I think that's going to be very supportive for gold in the longer term.
Lots to think about, and thanks so much, Cameron, for sharing all these really valuable insights on the impact on both the physical and financial markets. And huge thanks to everyone for tuning into today's live stream. I hope you enjoyed it. And if you want to find out more about Refinitiv's metals research and analysis, we'll provide a link to it in the chat, but also you can scan the QR code on screen now. And I encourage you, as always, to sign up to our social media channels so you get notified for our next Refinitiv Perspectives Live. Until then, take care, and I hope to see you soon.